Hello, everyone. My name is Brittany Button, and I'm a long-term care insurance specialist at Art Jetter and Company. Thank you for tuning in today on this highly anticipated presentation from Securian Financial. We are joined by John Thomas, Regional Sales Manager for Securian Financial. Today, we are going to review different client profiles and how to find the best fit for a long-term care insurance solution for each. With Long-Term Care Insurance Awareness Month right around the corner, this should help you uncover more clients in your own book of business. So without further delay, John, I'm going to turn it over to you.
Fantastic. Well, hello. Thank you, Brittany. It's wonderful to be with you all. And thank you again, Brittany, for inviting me on, especially as we kick off Long-Term Care Awareness Month. I'm thrilled to share with you all. As Brittany mentioned, again, I'm with Securian Financial. For those of you not familiar, Securian Financial is Minnesota Life Insurance Company. We've been around for 140 plus years, and we've been in the long-term care space for a little over a decade with a few different products. I joined Securian's team several years ago as they launched their asset-based long-term care product called Secure Care. And Securian has really grown in this market for the last several years to the point where we are a strong contributor to the long-term care space. In addition to that, we are a mutually held company. We're not public, and so you know that is important. Really, just to say that Securian's a company, or Minnesota Life is a company that you can trust to be around in the future to deliver on the promises that we write as insurance, right? The insurance policy we deliver is a promise that we're going to pay and help your client with their long-term care needs, maybe 10, 15, 20 years in the future. And so we have the kind of a longevity and profile that supports that. And Brittany, you know, I'm happy to talk about consumer profiles. I think this is really like a nuts and bolts conversation, or I hope you find it to be that way, right? That this is a nuts and bolts. Hey, here are the consumer profiles that we tend to write our policies on. And so as you listen to the conversation, I hope you hear some different client profiles that you say, hey, I have that client, or I have that client, or I know these folks in that market, and I can talk to more of those folks about this opportunity. So as I have the conversation here, I'm going to talk just a little bit about the long-term care planning, some things to think about, highlight a few things on our product and where our product fits, and then jump into these particular consumer profiles. So, you know, I know a lot of you on this call are experts in this market, right? That you're familiar with elder care planning. Maybe you do some med sup planning, or you're in the elder market and you know how to have a conversation on long-term care planning. It really gets to a 4-step planning process from our position, right? That you address the basics, which is really helping folks understand the risk of not having a long-term care plan. Right, and for that long-term care plan to be effective, you need to understand your client. You need to fact find, right? You need to ask them questions about their life, their family, and really understand their particular situation. And then address any concerns or objections that they have, right? If we're talking a long-term care insurance policy, one that is going to cost something on a monthly basis, or maybe one that's investment-based that requires a big investment up front, folks are going to have questions and concerns and objections. And so it makes sense to address those before you get into the point where you present the solution, right? Here is the solution to your challenge, right? We've got this much saved for retirement. Long-term care might cost that much, and you don't have enough in the bank to cover it. Or it's going to put substantial strain on your retirement plan if we don't have some insurance plan or some plan in place to address this risk, right? And so if we've help them understand the risk, we understand the client, we fact found a little bit, we've overcome or addressed their concerns, objections, then we can present a solution that's meaningful for the client to act on, right? And from my position, this conversation, it really should be within the retirement planning conversation. You know, I know that, like me, you know, you talk to your clients and you mention the word insurance, and people get really excited and they jump up and down and they say, I love insurance, right? that's often the situation. No, I joke. I know that insurance can be a challenging conversation to have, particularly when we're introducing an idea that that requires underwriting and an application and a process that requires approval, right? That somebody is subjecting themselves to review and medical scrutiny, and they have to get approved. And so there are some challenges to this process. But in setting up the conversation, this is really about retirement planning. Has this individual, this client you're talking to, have they reviewed their financial and personal goals, and have they planned for longevity and the unexpected? Because the truth of the matter is, if you live long enough, you're going to get to a point where you need some help. And so we often plan for what I think of as phase one of retirement. This is where we save, and we have our retirement accounts, and we plan for this income that's going to create enough to support our lifestyle, the lifestyle to travel and to golf and to join clubs and hang out with friends and family, right? We don't often plan for phase two, which is that aging in place. We live long and we start to age, and then we need some help. Right? We need help around the house. We need help keeping up with the yard and the kitchen. Maybe we need help with mobility, getting around in the house. And we start to need help with those activities of daily living, maybe getting dressed, bathing, those things that are going to require some caregiver support. And so have we planned for additional income to not only meet our lifestyle, but the additional costs of that caregiving? Right? In addition to longevity, right, there's limitations on our government programs, Medicare, Medicaid. I'm not going to spend a lot of time on that. I think many of you on the call understand the limitations of those programs. Rising costs of care. Will the type of care your client wants be there when they need it, right? Or in your community, are there questions or concerns about caregiver shortages, and what are the potential solutions to those? And as we think about that retirement account, right, as I mentioned, we have this retirement account set aside that is intended to create this stream of income for our lifestyle. Those are things like your mortgage or your house payment, food, transportation, debt, even charity and travel and vacations. And so you have that stream of income. But if we have this situation where we age to the place where we need care, now we're putting double duty on that retirement income. Is it enough to cover that initial lifestyle and the additional help that we may need down the road? So that double duty puts a lot of risk on our thoughts about retirement. And so our conversation really is to get realistic with this risk, right? Identify what assets and income the individual has, and the risk and care costs that they may incur. What is the risk really, and how would it affect their retirement plan? And in addition, if they have sufficient assets or significant assets and income, is there a way to better position their portfolio to put them in a better tax position? Can they use something like long-term care insurance to create tax-free income to meet their long-term care needs, right? Versus using this taxable income or liquidating investments to be able to provide for that care. Right, so that's the conversation, the general conversation on long-term care planning and setting up the conversation. Then when we get to solutions, Secure Care, as I mentioned, is an asset-based product that has a couple of guarantees. It's built on a whole life policy, with life insurance or a death benefit and long-term care benefits. And it essentially offers this value proposition, right? That there are 4 essential guarantees. We buy this whole life policy, and it ensures that if we need care or need long-term care, there's a guaranteed cash benefit long-term care income payment. And I say income payment or cash benefit because it is an indemnity benefit that pays a monthly benefit regardless of what your care need is or your care cost is. Because it's indemnity, we're not reimbursing your cost of care. We're paying a stated monthly benefit based on the need that you have a need for long-term care based on activities of daily living or cognitive impairment, right? If you were to pass away, if you were to die, there's a death benefit associated that you would receive a death benefit if you passed away and didn't use long-term care or need long-term care. There's liquidity. There's liquidity options that if you want to cancel it, you can get all or some of your money back, depending on how we design the policy. And if you are on a multi-pay, if you're paying it over a period of time and you stop paying premiums, we guarantee that in no matter what the situation, your policy is not going to lapse. You can agree to a 10-year payment and go 5 years or 3, 4 years, stop paying premium, and you'll have a guaranteed reduced benefit based on the proportion of premium that you've paid into the policy. Now, I mentioned liquidity. There are 3 liquidity options. There's a vesting, which guarantees 100% of your investment or your premium back after 5 years, should you decide to cancel your policy. There's another option that's a 75% flat option. You cancel it at any time after you buy the policy, you can get 75% of your premium back. Or what we call our LTC Boost option. This LTC Boost option is designed to give you the most leverage for long-term care, and it does not have a overriding return of premium. What it says is, or what it ensures, is that if you cancel the policy, you will get the underlying cash value in the whole life contract. And so depending on when you cancel it, that whole life cash value could be, 50, 60, 70% of the premium that you've paid. It just depends on what's in that whole life cash value and how long it's been accumulating interest in the whole life contract. Now, to give you an example of what this looks like, we often write a 6-year benefit and a 3% compound inflation rider. I know many of you are probably familiar with this infographic. It's used with many of the carriers that have products in this market, right? And we often use a $100,000 single pay premium or investment to highlight an example of how it works, and so you can easily see what the leverage looks like. This is an example of a 60-year-old female investing $100,000. And it ensures a couple of buckets you see illustrated here. That base bucket is the death benefit. On the top of the death benefit, there's an attached long-term care policy, or what we call the extension of long-term care agreement. These 2 buckets together create that total long-term care benefit package. Now, if this individual were to pass away and not need care, they'd receive this initial death benefit bucket. If they did need long-term care and started to accelerate this benefit, and you'll see it to the right is $7,708 a month at age 85, that's what it's grown to with the 3% compound inflation. If she were to accelerate that $7,700 a month, it would take 2 years to exhaust that base death benefit policy. Once that first death benefit bucket is exhausted, and that would take 2 years, we then move into the attached long-term care agreement, which would pay out over an additional 4 years, and that's what creates a 6-year benefit. Now, this is a common scenario, a 6-year scenario. Brittany, who is phenomenal at understanding all of the products in the space, and particularly our product, will absolutely help design a best fit solution or design for your client. But from a Securian perspective, we can offer benefits anywhere from 4 to 8 years at the longest. There are other products that could go, a little bit shorter or even a little bit longer, up to an unlimited or lifetime benefit. And it's really depending on that client's longevity concerns and needs, what's a best fit design. I will say 6 years happens to be pretty common in the market. It is based on the average long-term care need being about 4.5 years. And so a 6-year benefit really covers that average need. And of course, an average means half people will be on claim less than that 4.5 years, and half people will be on claim a little bit longer, right? So 6 years, covers that average and gives us a little bit more time to ensure that we're providing a benefit that's going to meet the need for a majority of individuals. Now, if you look at the difference in benefit between those 3 ROPs or liquidity options that I highlighted, the vesting, the 75%, or an LTC boost. To give you a quick example, if we take a 65-year-old female, and you'll see on the screen here this infographic that highlights long-term care benefit in dark green. The light dark green, and that's at age 85, so what's accumulated with our 3% compound inflation. So by her age 85, the vesting option is roughly $400,000. The 75% on the other hand is about $467,000, and the LTC boost is going to give her about $500,000 of coverage at age 85. And so there's a trade-off here, and it's a difference of about $100,000 in long-term care benefit with that 3% growth to her age 85. But the trade-off on cash value, if she were to cancel it, she's no longer going to have full liquidity, she couldn't get her 100% back. The LTC boost would say she'd get about $60,000 back based on the underlying value in her whole life cash value. So that should give you a sense of how this product kind of works and the leverage of the different investing options and how much we can crank up the LTC or preserve liquidity if that's an important feature to your client. We do have payment options anywhere from a single to 15 pay, so we could spread those payments out over 15 years. This quick chart will give you an idea or sense of what that benefit might be, whether we're talking $100,000 invested right up front for a 60-year-old to it spread out over 15 years, so $6,667 a year for 15 years. Now, the good part. So getting into prospect profiles. We're prospecting, okay, we're thinking about positioning, any long-term care solution to a client and what Securion's product looks like. Now, who is this good for, right? Who do we sell to? Who do we talk to? What are the right profiles of people to focus on? So just overall, the average secure care prospect, or who we sell a majority of our products to, are folks between the age of 48 and 68 is our primary market. Now, the product is available from age 40 to 75, but really a majority of our sales are from about 48 to 68. Right, folks primarily don't start that long-term care planning thought process until near retirement. So as they're entering into that near 50 age, they start to think a little bit more seriously about long-term care planning, right? And on the tail end, by late 60s and getting into the 70s, from a health standpoint, it becomes a little bit harder to qualify, right? By the time you're 69, 70, some of those chronic illnesses and chronic conditions have started to shown up in people's bodies, right? And so it gets a little bit harder to qualify. And because of the risk of riding on a 70-year-old, by the time someone gets to 70, the leverage we can get on a individual policy is a little bit less than someone that's 10 years younger. And so that really has identified that 48 to 68 as the primary market. Now, from a asset perspective, middle market to affluent is primarily who our focus is. Those that have significant savings or high income or a significant or adequate retirement plan, and then somewhat average to good health, right? Not significantly impaired. Nobody that has a severe chronic illness currently, because they're going to be a high risk for long-term care claim in the future. So average to good health is our primary prospect. And I'm going to talk through a couple of profiles: the affluent prospect, the experience-driven prospect, the business prospect, a younger prospect, the middle market, expats, and the older but healthy single prospect. And I emphasize that older but also healthy, or relatively healthy for their age, right? Not early signs of Alzheimer's or chronic illness that's set into a significant degree. Now, starting with the affluent prospect, right? So with these profiles, I really attempt to highlight what's possible for anyone in this category, right? And so for your affluent person who, their default or their plan right now, without a written plan for long-term care, their plan is to self-fund, right? They're just going to pay for whatever costs come their way out of pocket. They have assets set aside. They've got some liquid assets. They've got retirement plans, probably an IRA or 401k, and so they're not all that concerned about the cost of long-term care. But one of the things to realize about affluent folks, right, is that a lot of their assets, a lot of their money, whether they have $1 million, a couple $1 billion, a lot of that's going to be invested. And so many of these folks have limited liquidity. And they're going to use some of that liquidity for emergencies, medical costs, other things. They may have a spending lifestyle that uses that limited liquidity that they keep on hand here and there, right? And so they need liquid income for their care. They also have a desire to protect their legacy and keep invested assets intact. Right? If we said you need to create an extra $10,000, $15,000, $20,000 a month for round-the-clock care in your home, which is probably what you desire, right? Where's that money going to come from? Are you going to sell some of those mutual funds? Are you going to sell your stock holdings, right? Who knows what time in the market is going to be. Most people are invested in those portfolios that they have stock in, or the mutual fund assets, so they don't want to liquidate those. And there are also questions of tax efficiency. Could we invest some of what they have liquid today in a vehicle that's going to give them some tax arbitrage and position them in a better place from a tax planning perspective? So to the right, I'm using a couple of snapshots of hypothetical illustrations. So you'll see some snapshots of the Securian Secure Care illustration. To the right, you can see a male age 55, non-tobacco couple rating. So he is married with a single pay of $150,000. So it's an affluent individual. They have a large portfolio to protect. And so we're going to look at a bigger policy. We'll design a 6-year policy, 3% compound inflation. You'll see the day one benefit is roughly $519,000 or $520,000. By age 85, you'll see that benefit grows to about $1.26 million. There is a face amount or death benefit of roughly $160,000, and a residual death benefit. If they use up all of that initial death benefit for long-term care and pass away, there's a residual death benefit of $10,000 that's still paid at death, kind of an attached final expense policy. And so this does a couple of things, right? We're taking $150,000 of what they have today liquid that we know is available, that they've got it in maybe a money market or CD or savings account, right? We're going to reposition it to protect the rest of their portfolio. So we're repositioning 150 to create at their age 85 1.26 or almost 1.3 million of long-term care benefits. And so that'll create income monthly of $16,000 of income specifically for long-term care. It's a cash indemnity benefit, so that income can be used however they see fit. If the spouse or wife is providing care, or kids or niece or nephews, right? We can pay family members to be involved in that care. But the bigger picture is that this is a tax-free income for long-term care that's going to protect the rest of their assets, is going to protect their investment in their holdings, is going to make sure that whatever a legacy they have in mind for those assets stays intact. If those investment holdings, they plan to give them to their kids, they plan to pass them down to their grandkids, those investment holdings are intact. So this is a great way to really beef up someone's overall portfolio to make sure they're protected from this increase in income needs because of long-term care costs. Right now, the experience-driven prospect, this is an individual who's had a personal experience providing care. Right, this is something that I would label my mom, who has been providing care for the last 9 years to my great aunt. She's her primary caregiver. She coordinates her care. She's roped in my two sisters to help provide care on a week-by-week basis, and then coordinates with paid caregivers throughout the week to provide round-the-clock care for my great aunt, who several months ago turned 101. And so she has a lot of experience in this caregiving lifestyle challenge and understand some of the needs of a caregiver, right? And so from an experience-driven prospect, this person with experience is going to understand a lot of the consideration on the day-to-day experience of the person in need and the caregiver. And we feel like the secure care contract, but really indemnity contracts are well suited to approach this experience-driven prospect, someone who's had this experience from a day-to-day. And the cash indemnity benefit creates a couple of things to think about. The first is that it's not reimbursement, and so you don't have the administrative work of sending the insurance company bills and receipts for your care to get reimbursed, right? But additionally, because it's indemnity, we're going to pay that benefit for informal care. So in this arrangement, like my mom, she can receive a benefit for my great aunt and pay my two sisters easily out of that income for the time during the week that they spend helping provide care. She can utilize caregivers that she has connected with through the church. Through the church, they have retired caregivers or retired nurses that have gotten into caregiving, but they're not necessarily part of a licensed caregiving agency. And so that would be another type of informal caregiver that's part of the community, but not part of an agency, right? And so that informal caregiver can also be paid easily from this indemnity contract. Another thing to keep in mind, if you look at this chart to the right, it is the nature of the benefit and how it's going to pay out in a changing care environment. So what we understand about care is that it is progressive in nature, right? That it often starts as we age in place, it often starts at home, and it starts with family, right? And family provides care as long as they can. And then as those needs progress, we bring in some paid help. And that paid help comes around and assists with family care. And then eventually it may get to the point where the needs of that individual are so great that they have to move to a facility. Maybe it's assisted living, maybe it's a full facility nursing home. Whatever the case may be, there's this progressive nature to the care need. And so in a progressive type of situation, the likelihood is that you're going to get more out of your indemnity contract than you will a reimbursement contract. And so when you're talking to this experience-driven prospect, you can say, hey, I understand what you may have seen of the long-term care system or insurance that reimburses cost. Take a look at this indemnity contract and what it can offer. And on the right here, and we have this in one of our marketing pieces, this example, it shows in this progressive type of care situation, 2 years of informal care, 2 years of care at home, and then another 2 years at an assisted living facility. And what it shows is that in that informal care situation, if a family member or spouse is providing care, that reimbursement policy is maybe not reimbursing anything because we don't have an agency submitting cost for that care, right? It's being covered by a spouse or immediate family member. Whereas the indemnity contract is going to pay the full benefit in those early years where informal care is the primary mode of care. So you'll see on the right here, in the first 2 years, the reimbursement contract did not have a benefit, but the indemnity contract paid us $326,000. In the next couple of years, we're getting some assistance at home. Healthcare agency is sending nurses to the house to help out. The cost of that was $110,000 over that period, right? And so that was reimbursed. They did help us. They covered our costs. It's fantastic. The indemnity contract, on the other hand, continued to pay the full benefit, even though it was more than what the nurses that we paid to come to the house cost. And in the final years, right, say our individual moved to assisted living, the cost of that was about $210,000. The indemnity contract continued to pay the full benefit. So we exhausted the policy in the indemnity contract at a little over $1 million, whereas the reimbursement contract, it did reimburse us for all of our costs at $320,000, but we were able to get more out of this indemnity contract, more that maybe could be passed down and used as part of a legacy because we didn't need it. It was more than our cost of providing care. So there's an opportunity here and an ease of use with indemnity. Now, I will preface this and say this is probably an extreme example, right, where you're going to get $760,000 more out of an indemnity policy, but you can kind of see how in a changing care scenario, how this indemnity contract might provide us a bit more benefit. All right, the business contract or prospect. So in long-term care planning, right, particularly with traditional long-term care, for those of you who have sold traditional long-term care plans, you may understand or know that the long-term care premium is potentially deductible, right? What a lot of folks don't know is that these asset-based products that offer, in addition to just long-term care, they offer death benefit and liquidity, right? That these solutions may also be deductible, or a portion of them may be deductible. We're starting to do quite a bit more business, particularly in S Corps and C Corps, businesses that are using these policies as an employee benefit, really to retain key employees in the business. Think of a smaller business, maybe a corporation that has 10 executives at the C-suite level. it might have been founded and family owned, and so there's the business owner, and maybe his spouse or his kid is helping run the business. But then there's a level of employees that have been at the business a long time. With our current market, there's the need to offer additional benefits to that next level of employees that are valuable to the business, right? And with everyone's concerns around long-term care planning, a long-term care plan might be a powerful executive benefit to offer those folks. And so with that idea, there are a couple of different options for an S corp, a pass-through business, a C corp, a fully deductible opportunity, or even HSA funding. A lot of employers are moving to high deductible health plans with HSAs, right? That you can shift some of your earnings into an HSA, let that accumulate tax-free, and use that for health costs. And so when you look at a secure care policy, what we've done, we've designed it in a way that allows for potential deductibility on the LTC portion of the policy. So when you look at our illustration, you'll see this a little chart that you see to the right where it says non-deductible life and deductible long-term care. We've split the policy into two parts, the portion of the premium that represents the life insurance, and then the portion that represents long-term care. And that's the acceleration of long-term care on the life insurance or the base, the extension of long-term care agreement, and the long-term care inflation agreement. So those three of the total premium are available for potential deduction. Now, the IRS, they've set out a limit for the amount that we can deduct, whether you're talking an individual or an S corp, someone that has a small business that's a pass-through, and that pass-through taxation goes to their individual taxation, right? And HSA funding. So for an individual, S corp, or HSA funding, the IRS has set out these limitations, and you can see that table at the bottom here, from 40 all the way to 71 plus. Depending on the age range that they fall in, they could potentially deduct amount of that long-term care premium in the given year. So for the age 61 to 70, for example, you'll have 4,510 that someone could deduct above the line if they're in an S corp. Right, that's a straight above the line deduction. I'm going to take 4,510 of my long-term care premium and deduct it as a benefit to me, a small business owner. Someone that has an HSA, hey, I'm going to take 4,510 of my HSA. Maybe I'm doing $10,000 a year into my long-term care policy, so that 4,510 from my HSA, and the other 5,500 I'll pay out of pocket. So there's the opportunity for a little bit of arbitrage there. A C corporation, as a benefit, an employer that's providing a true employee benefit, that C corporation can fully deduct all of the long-term care premium, the life and the long-term care portion. So there's a huge opportunity there. Now, I'm not going to get into a ton of detail. If that's something you're interested in, business planning, and you have business prospects, absolutely follow up with Brittany. She understands how this works and have some resources from us that are worksheets to help you determine from an individual or an S corp or C corp, how to do the taxation, what's potentially deductible. But just to give you an idea of what's possible here as you think about your business prospects. Let's take a 50-year-old female. She's starting to think about retirement, right? Her business thinks she's valuable and thinking about this opportunity to offer her some additional benefit, right? Or maybe it's her business. Maybe she's an S corp owner and she wants to use the benefit of this taxation opportunity to buy a policy on herself from her own business. And so we're going to do a 10-pay, fund the policy over 10 years, a little over $10,000 a year. You'll see it highlighted there, $10,264 in premium. By her age 85, that's going to provide $937, almost $938,000 in long-term care benefits to the tune of $11,500 a month, roughly. To the right, and you'll see this in each of our illustrations, you'll see a detailed premium report on the third page of the illustration that'll break out the amount of premium that represents the life insurance, or face amount is how it's listed, and the amount that represents the long-term care. So I've highlighted it there in yellow that out of this 10,264, a majority of that, about 8,000 of that, 8,200 of that, represents long-term care. And so if she was in an S corp, she could take that 8,000 and deduct up to the age-based limit we see on the screen. So she's at 50. Today it would be $850. Next year it'd be $1,690. When she turns 61, she could jump up to that 4,510 and make that deduction from an S corp, or use that amount from her HSA. The big opportunity is in that C corp, in the true business, where we're talking about a key executive or business plan. All right, we'll jump to a younger prospect. So, I mentioned early on that a majority of folks that are buying long-term care are getting nearer to retirement. They're thinking about retirement, but there is a huge opportunity for these younger folks. And it's really because we can lock in their insurability while they're healthy and get a jump on locking in this inflation growth. And I'll show you what I mean by highlighting the premium and long-term care potential. So to the left, I've got a screenshot from a proposal, a male age 40, investing a single pay of $29,495. So a single pay of $29,000 and a half. By his age 85, that roughly $30,000 investment has grown to $611,000. That's going to create a tax-free income monthly of about $78. So turning 30,000 into a little over 600,000 isn't a bad deal, particularly when we're talking about something that creates tax-free income for this long-term care purpose. Right now, I highlighted a single pay. You can see in my chart here that to create that same benefit, whether we funded it over 1 year, 5 years, 7 years, 10 years, or 15 years, it's still a substantial opportunity. If we didn't do the 29,000 single pay, we could do a 5-year payment of 6,516. Over 10 years, that breaks out to $3,602. So just $3,600 a year for 10 years would get us $600,000 in long-term care. If we spread that out over 15 years, we're talking $2,748 a year. So for fairly limited costs, and I know when we're doing these kind of comparisons, we love to compare it to, a cost, a couple of cups of Starbucks a month or whatever it breaks out to, right? Or a day, I guess we should say in this case. But for minimal cost, for that 40-year-old that's earning great income, this is a limited expense that's going to create a substantial benefit if we get that early jump start. Now, the middle market prospect. And Brittany, I'm going to try to keep it under 40 minutes here. We're coming up to a few minutes left. So I've got just a couple of profiles left, and then we will wrap it up and I will pass it back to you. But the middle market prospect, so, we often focus on that middle to affluent market. But in your middle market, you have folks that have limited income, right? And so a big expense or a big premium is going to be something that's serious for them to think about, because it's a big investment and it's a big part of maybe what they take home. And so for those middle market folks, I like to think of a limited annual premium, something in the ballpark of $5,000 a year. And so you'll see that highlighted, a 48-year-old female, $75,000 over 15 years, or $5,000 annually for that 15-year period. It grows by age 85. You can see it highlighted, about $644,000 in long-term care. On the left-hand side, you can see the difference between this vesting 75% or LTC boost option, right? So we're talking $644,000 roughly in long-term care by her age 85 with the LTC boost. But as someone in the middle market, they may have concerns about having access to any money that they can touch, right? Maybe they're in a business that's a little volatile. Maybe they're concerned about the current market, right? And a lot of this talk about a depression that's going to last us a significant amount of time. And so they may not want to tie their money up. They may want to have access to it. So this vesting option, it's going to give us 80% ROP today, and that grows to 100% after 5 years. So after 5 years, she could get all of her money back, and we'd still have a significant long-term care benefit, 514 by her age 85, to retain that liquidity. So that might be a valuable option for this 48-year-old female. And in addition, because she has concerns about investing in this type of policy, that's a long-term investment that's going to tie some of her money up. You can see what the reduced paid up benefit guarantee is to the right. I mentioned that early in the call, that we cancel it at any time. We're going to have a reduced benefit. So you can see that if she pays it for 70 years and stops paying premium, right? She's paid in 7 years of $5,000. We've got total long-term care of 119,437. That breaks out to $1,539 a month, and that will continue to grow with that 3% compound, right? And so that guarantee really helps folks see that even if something happens, they can't continue paying premium, they've got a fallback plan. They can stop paying premium and accept a reduced policy. And maybe it's not enough to cover their entire risk, but it is significant, right? An extra $1,500 or $3,000 to our what might be $5,000, $6,000, $7,000 a month is a valuable add, right? And in 10 years or 15 years down the road, she wants to add another long-term care policy to this, she certainly could. All right, the expat prospect. And so just briefly want to highlight the way that Securian looks at folks that are going to retire internationally. And we have a pretty interesting benefit. It's interesting in the fact that we're going to pay 100% of the total long-term care for folks that retire or receive benefit outside of the U.S. So that does include Canada, or anywhere else outside of the contiguous United States, that they will receive 100% of the benefit. So when I say 100% of the benefit, you see that infographic to the left, the three buckets, the base policy plus the extension that creates the full amount of benefit. With each of the other carriers in the market, and I've highlighted a few of the other primary competitors or carriers in the space, right? They're going to provide 100% of your monthly benefit of just that base, just that first bucket that represents the amount available for death benefit. What Securian has said is that we're going to offer you both buckets, both the base and that extension, and we're going to pay at a rate of 50% of the monthly amount. And so unlike the other folks that are going to pay you 100% of your monthly, but just that first bucket, we're going to give you both, but we're going to cap your monthly amount to half of what's available. And so in a sense, it's going to take you twice the amount of time to get through the entire benefit pool. But you have it all available and you can use it all. So for your 4-year benefit, it would take 8 years to exhaust it all. For your 6-year, it would take 12, right? And so for those folks, I would recommend maybe designing that 4-year benefit. That way they can ensure that over 6, 7, or 8 years, they get a majority of their benefit. They get the base and well into that extension. All right, and I'll close it with this older and healthy single, maybe widow or widower prospect, right? And so I'm going to look at a female age 72 with you here. And the concern for a 72-year-old is that they're at the age where we're not going to get a ton of leverage for a dollar, right? That would be the initial assumption. But this 72-year-old widow is healthy. And if she's healthy, then we need to plan for longevity, right? Longevity and care is still a big concern. And so there's still an opportunity to leverage what she has today, put her into a better tax position, right? By using this insurance to create tax-free income for care. And with that inflation, the 3% compound, we can still create a valuable benefit. So I've highlighted $150,000 single pay, reallocating some of her liquid assets, creating an 8-year policy, 3% compound. And at age 85, that's still going to give us a benefit pool. So it's grown from 72 to age 85. So what is that? 13 years of growth. She's going to have about $455,000 of LTC benefit pool pay out over 8 years. It's $4,200 a month, right? And so we have tripled her investment for an 8-year benefit, right? In addition, something to think about is securing, along with a lot of the other carriers in the space, have what we call care concierge or care management programs that are built into the policy. And that is a huge and valuable add in and of itself, that once you have this policy and you need care, you're placed into the care of a care manager through this program because you're a policyholder. And that care management or care manager is with you through the life of a claim, is going to help you find vetted and trusted local care services. If that individual or their family needs help, knowing whether one facility is better than another, or what's been a trusted name in that area, they can help that individual find trusted services. If they need to find at-home caregivers that are trusted to come into the home and help care for that loved one, they're known and renowned in the industry for these vetted and trusted care servicers. And that care manager is going to also help with the claim process and understanding the policy, and available to call by that individual and their family. So that's something in and of itself that is such a valuable part of these policies, particularly for those older individuals that maybe are single and don't have that spouse to lean on for support. For a lot of the things I've highlighted in the conversation and some of the tax material and these ideas, you can absolutely go to our website, securian.com/secure care. But I would say, before do that, talk to Brittany. She's fantastic, and I know that she has her hands on a lot of our material and other material that's going to assist you in pulling together a valuable long-term care plan for your client. So it was great to be with you, Brittany. Thank you again for inviting me. Hope you all found something that you're going to take and talk to some of these prospects about in Long-Term Care Awareness Month. So Brittany, I'm going to pass it back to you with that.
All right. Well, John, thank you. As always, great information you covered for us today. And thank you to everyone that's tuning in on this session as well. We encourage all of you to start thinking about people you need to start the planning conversation with. So our team is standing by if there are any further questions, or you would like some of these materials that were mentioned. Of course, to get appointed with Securian Financial, please visit our website, Jetter, JETTER.com, and simply click Get Appointed. So you can reach our team at 800-228-0008, or shoot us a quick email at LTCI@Jetter.com. Again, thank you everyone for joining us. Enjoy the rest of your day.